Hello everyone, today is November 19th and this is the 11th session of the Wyckoff Practicum course. Do you guys know that this is the last cycle of the practicum? There will be no practicum, official practicum course. It's going to be just WTC part number 2, which we will call, unofficially practicum. So this is still going to be the same class. Today, we're not going to talk about the selection. We're going to concentrate today on the bias game because I've been receiving quite a few emails in regards to the last two bias games and how similar they are in the structure and in the signature and how different they are in the bias. So some of you expressed this kind of like, desire to go through this again. I first thought, well, maybe this is kind of like, with each bias game, we have something like this. And by the way, guys, I want to talk about this a little bit, but maybe we should jump into that bias game. But all right, um, I've told you guys that the your ratio between the correct answers and incorrect answers is probably where you are right now with this material, specifically with the analysis on the bias side, right? So is it accumulation or is it distribution? So that's number one. And a lot of you were coming to me in the emails and were saying like, I see your point now. Like if I would be stripped of all of my insecurities and I would say, okay, I have to be extremely transparent with myself and this is my knowledge, this is where you are. Having said this, some of you guys, expressed some anxiety that, oh, my rate is not that high. I want to reiterate that our goal here in this classroom is to get you over 40% level. Why 40%? Because if you are trading and each trade contains, let's say, 3-to-1 reward to risk built in, then with 40% being correct, you will be making money. You will definitely not lose money. You will be making money. It's just a matter of how much you're going to be making money, because the sequence of trades could come in a different way. So you have to understand that as well. Then I also said that there is still something that we want to do, on our side, on Wyckoff Analytics side, on my side, to understand how to teach this material better. So I'm definitely taking a lot of responsibility. If some of you guys are, coming to the class and just saying like, I just don't feel any progress, I'd say embrace this moment. This is great. You see in something that maybe before was not seen, something that maybe you have not explored before, right? So suddenly it's on the surface. Let's be grateful for the knowledge, for the awareness that something is not working. And then let's make next step. Let's definitely dwell more on like, wow, this is great. I'm failing, so I know that I'm failing, because in a lot of cases we just don't know that we fail. We kind of hide it from us. Well, this game exposes you, you know, to the kind of like to the last thought that you have about what this is. So another thing that I want to say is that I probably uh, came out as this kind of like persona that knows it all, and therefore every call that I make is correct. This is far from the truth. And a lot of my trades are not winning trades. And it's not because I don't know how to do this correctly. It's just mostly is because sometimes I just don't do this correctly. So it's in the process, right? And sometimes I totally miss it. You know, there are some blind spots on the analysis side that I have. So the key for my own individual progression there is always to find those blind spots. Like I get excited when I feel raw with the material. Like I don't know, I just like this feeling of like, I'm not sure. I'm not sure. So there are a couple of spots like this, and I'm excited about them. Why? Because, well, I know that the more I pay attention and analyze and, you know, build it into the structure of how the logic unfolds there, then the quicker, you know, I eliminate this blind spot. The same is for you. You should be looking for those blind spots. If you're feeling frustrated, notice that, right? And then, you know, like, how would I work with you in the private session? Notice that feeling that you're frustrated, acknowledge it, because, you know, if you don't acknowledge this, it's going to pop up somewhere else somehow, in a trade or in a conversation or in the exercise, anything. And then once you acknowledge that feeling, you know, what is the next step for improvement, right? So, okay, what is the benefit of that step? What is the cost of that step? Am I willing to make that step? How do I actually make it? How do I incorporate it in my process? I think that we've created a great process here with the practicum where each week we have this discussion on the bias, right? Eric is saying it's difficult to accept that there is no certainty in trading. It's a game of probabilities. I would agree with that. And, you know, when I play poker, I always think about trading and, you know, what is kind of like easier to play, what is harder. To me, poker is much harder because of that uncertainty, because there is much more uncertainty in poker game than, at least to me, how I feel it, you know, than with the markets. The markets, once, you know, there is an edge. Once the trend is established, it's there. It's going to stay there for the whole price cycle. We don't know exactly when the price cycle will end, but we'll see some signs and we'll kind of act on that. And in poker, you don't know which card comes next. There could be, let's say, only 20 cards left, but how do you know exactly which one is going to come? You have the probabilities, but probabilities even work when, let's say, 95% is going to be a black card, and then only 5% is going to work out as a red card, and that's it. So you kind of have to accept this. In the markets, more uncertainty in like every day-to-day move. Sometimes there are periods where there is uncertainty because there is no institutional sponsorship. But once there is an institutional sponsorship, once they show up their hand, then all bets are off. You know, they will sustain the trend with their behaviors unless, you know, something like extreme comes. And you could create that edge. And we're trying to create that edge through the bias game, right? So we want to understand what are institutions doing in the specific structure and how do we play it. So let's jump into this. As always, our discussions here are for educational purposes. Please stop this recording and read the whole disclaimer. And I'm going to start with different looks. I'm going to give you guys your work, right? Because you send that to me. I go through each homework. If I don't reply, you know, this means either I don't have a significant reply or I'm not replying just kind of like, you know, in general, right? Because, you know, I'm just running out of time or anything of this sort. So today we're gonna spend a lot of time on the bias, and I want you to start on the kind of like following some kind of, you know, I want to develop step by step for you because I think this is where it's all going. You're basically asking me for a step by step approach as to how do I analyze specific chart for the bias. And hopefully by the end of it, maybe going into the next session, we'll do that, right? So this comes from Corey, I believe. I didn't put the name here, but I believe it was Corey. Corey, was it you? Let me just see if Corey is here. Yeah, okay, let me know, Corey. Or whoever this is, let me know. Yes, okay, great, Corey, thank you. So we're just gonna go through questions, and then we're gonna come back and we kind of like we'll do this exercise, or redo this exercise. First question: in which scenario we can say the shakeout was observed by demand quickly, showing bullish character within 1 or 2 days? And that was the question for many of you. This whole move, is this what is it, right? What is it? Let's just say that this is, let's go through the structure. If this is an accumulation or reaccumulation rather, then how would we label this, right? So this would presumably be phase C. Then this happens in phase B. We probably would label this is still a test of what came before. The test suggests that there is more supply at this point, or demand is weaker, and therefore this will be a test, and because this is a low as a minor sign of weakness. This is a reaccumulation labeling. If this is a distribution, then we're still gonna have that element of the sign of weakness, right? And I think this is just something that maybe we kind of neglected as a group a little bit. What does it mean, let's say, for the distribution to have that sign of weakness in the middle of the range in phase B? It kind of shows you that there is a progression to the downside. We had previous attempt to go down, next attempt to go down, and then the next one is successful. On the increase in supply signature, we have increase of the result to the downside. So at this point, we're going to be bearish, and we're going to say that the next rally is going to be either confirming that bias, or it's going to fail, and the bias is going to change. Okay, so that's that question. Hold on a second. How quickly we would be judging bullish, behavior, right? So we're seeing a lot of effort coming in here on this bar, and then there is still continuation. The volume is pretty high, but there is less progress, so result is diminishing, effort stays high, so that suggests some demand is there. And then here is your recovery. It does look like a spring because recovery happens, really quickly. So I probably would be thinking here that this was some kind of like oversold condition. That's why the price recovers really fast. But it definitely had some elements of the supply. If you look at this bar, if you look at this bar, then this bar, you see that supply has come at the top into the value cell. Then we had an increase of supply and increase of supply going through the support. So this whole area right here looks like selling first value, and then there is an acceleration of selling into the low of this reaction. Compare that with, let's say, well, maybe not the greatest example here, but compare that, let's say, with this reaction, right? So we have like 1, 2, 3 lows. 1, 2, 3. So we see that there is some kind of diminished supply characteristic at the end of this reaction. Whereas this signature is slightly different, right? So we see more of kind of like increase of the supply throughout this whole thing. Increase into the value selling, increase on the way to the downside, and then increase into the capitulation zone. So it seems like there is a lot of synchronicity with which effort is increasing to the downside and result to the downside is increasing. And that suggests this bearish bias. Okay, well, if we're talking about the bearish bias, then what has happened prior to that? Supply comes in, stops temporarily, the price from moving up, more supply, and then less supply, less demand, even less supply and less demand on this rally. We are expecting some kind of reaction because we see how the price stops from moving further up. It was moving on decreasing volume signature, then volume increased, effort increased, and what do we have? We have less of the result to the upside. That's bearish. Short term suggests a reaction. The reaction develops. We don't really have a lot of supply coming in here, so we would be thinking here that we're still in the reaccumulation bias. This reaction does not negate more than half of the profits that we have in the last run up. The next rally means really nothing because after the kind of like collision of the supply and demand around the buying climax area, you're gonna have an exhaustion by both. So you're gonna see a lot of the diminished volume signature going into phase B. You kind of have that. And then from here, from this higher low test, where you're still thinking that this is a reaccumulation, you're expecting the rally to overcome the resistance. Does that happen? No, it doesn't. So there is a failure. There is a failure, and remember that each rally that we have off the lows, so we are in the reaccumulation on the change of character. We are in the reaccumulation on the test as a high-low test. Some volume comes in and the price suggests that it's going to go higher. So now on this rally, our question is, does this rally confirm or fail the test, the reaccumulation bias? Well, there is a failure here, and then we see how supply starts to come in. So this is where we are changing the bias to a bearish bias. And now we are saying, okay, well, the next rally, you need to confirm or fail this bias. And I think that a lot of questions, from your emails were all about this rally. And it just, I don't know how it happened. Kind of white witching, maybe a little bit unconscious, or maybe just the patterns repeat themselves and we either don't see all of the differences in the pattern, or we have kind of like a false assumption, a false methodology. So we have to explore today, which one is which. So we'll try to figure it out. Well, if we go with the horizontal trading range, which Corey is using here, then what do we have? We have 1, 2, maybe 3 commitments to the upside. So that would be suggesting that the price could stay up above the resistance. But then the price still goes down, and then on the test, there is only 1 commitment, and then it fails. So if you take this whole area, you're thinking, okay, I had 1 attempt to go up and stay above, I failed. And then the second attempt had lesser characteristics based on the closest, the time above the resistance, plus it's a lower high. So it's most definitely is a failure. So it's interesting that the price fails 2 times now at the point of the resistance. And now that we are, coming back to the rally, we're starting to think, okay, if there are 2 failures here, this is probably just the demand that is, of poor quality. How could we else think about this, right? How could we possibly say that this is demand of poor quality? Well, we probably, looking obviously, the most important thing for us is the level of commitment. So we want to see that. If we're looking at the, let's say, downsloping range, and we were discussing this, and we would say that on the previous bias game, there was a downsloping range and the price spent a lot of time above. So, and we're looking at all of this. Yeah, there is a lot of, let's say, spending above the trading range. Okay, so then where is your next confirmation or failure of the bias is? I mean, like, if your concentration was on this rally and on this rally alone, and you interpret this as a bullish rally, then where is your confirmation that this is a bullish rally? Are you analyzing what happens next? And what happens next? Tries to commit and then still failure, even on the downsloping, right? So this is the failure right here. And then we want to look at the way how the failure happens. So in other words, the character with which the price travels to the downside. So we see in the first travel to the downside was a reaccumulation. The third one, we said, yeah, there is something of the distribution way how the price is just being sold consistently. It's being sold more and more and more on the downside, and the price reacts and creates significant lower low. And then the third one, the way how it fails, it comes to the resistance, and it comes on a very exciting rally if you look just at the price. So it looks some kind of point of excitement, maybe the last one, right? Because this is the first one, this is the second, just doesn't necessarily have that, volume characteristic for the second point of excitement, but definitely the price shows that. And then we have this failure. So if we're bullish here, then this should show us that failure. How do we fail? In which way? Well, first of all, we're spending more time now being sold. So think about institutions, how they're thinking, how they're kind of like making their judgment as to whether to be in this position or not. They will be looking into the absolute and relative performance. If the absolute performance goes down really quick but recovers quickly, they will still be in this position. If the price does not recover and kind of like stays in these underperforming conditions, then most likely they're going to get rid of it. And we kind of seen that through time. What do? They sell off the top, then they sell off the test, and then they sell into the capitulation as well. This was kind of like the test of the stop in action here. And we are seeing that some kind of rally is going to come up. So more time is being spent going down, and then also look at the result itself. We actually have a quite significant reaction. I believe this reaction, and this is what, 36 and a half, 28, so that's $8.50, and then this one is 35 and 26 and a half. Actually a little bit better, right? So we are 26 and a half and 25. Okay, so that's 8.5. No, the same, right? And sometimes we would be thinking, yeah, there is more aggression right here just because of how aggressively it went down. But wouldn't you, after the bullish rally, expect that there's going to be some kind of reaction that's going to be more of the bullish character? Do we see a lot of bullish character here? There are quite a few gaps to the downside. If we take swing by swing, then the middle of the swing is actually quite aggressive. So I would say that we probably fail in here, and we're still thinking that this is bearish. Well, we're expecting some kind of rally from here, So let the rally prove to us that it's bullish, and then we'll change the bias. Okay, well, what happens next? So stop in action, test, momentum bar. Now we could judge about, this momentum bar in, different ways. We could say that it's a really good volume signature, and after this type of momentum off the low, what should we see? So a bar like this, maybe a bar like this, and then some kind of continuation to the upside where this buy-in translates into increase of momentum, right? Definitely increase of momentum here, we're committing above, but this latest move to the upside neither has expanding demand nor expanding momentum signature. So it seems like there is just like this one strong push off the bottom, and then it goes into what? Into the upthrust, and the price does what? Fails immediately. I actually was contemplating a lot whether to include this bar or not, because to me that looked more like a reversal bar, and that gave such a clue to the bias that is about to come after this particular bar. And I feel that I was explaining to one of the students. He was asking me, why are you not including the significant reversal bars, that are bias bars, right? That are actually something like this, where we see a move to the upside and then it's being reversed by this bar. And I'm basically giving you the definition of the bias here. And I said to him, well, the goal here is not to define the bias by the last bar. The process here is more about how do we recognize the bias when we come to phase D, right? And we are in the middle of the trading range. This is the spot that we would call a springboard. It means that accumulation or distribution has been done. It has concluded itself. The main interests have distributed the stock or acquired the stock. And that's always the purpose of this exercise, to judge the bias by the action, by the Wyckoff story coming into the last bar. And then if the next bar, which is going to be a significant reversal bar, helps you out, well, this is even better, right? So your rate should go way, way higher, than this. And that's kind of like the challenge of the exercise, and that's my challenge to you and to myself as well. I did have doubt here since the supply volume was higher than phase A and B, but I believe recovery of the shakeout was so bullish, so I kept bullish bias. Again, where is the mistake in the logic here, Corey? I think it's in the last statement. Even if you are seeing bullishness, which it was, I mean, the rally still produced a meaningful result. I think that you're doubting the character of the rise in volume. That's number one. So here's one doubt. And then your second doubt is going to come here around the failure at the top. But as the rally develops, you're probably going to have that bullish, bias, which is okay because you're still in a trading range, and there's still some development here that is needed. You might even have a trade here. You might say, I'm going to come in right here because I'm thinking that this is phase C, and then you should be getting out somewhere here. This is your exit. So then you have a short profitable trade. This is an acceptable trade for us. Even if we're mistaken in terms of the effort that is decreasing, and we are seeing this still as a result mostly, the price going up and committing to the resistance. So at some point, that bias from bullish should be changed to bearish. And then in this area right here, you either confirm or you look for the failure. And then we're seeing how the price fails. All right, let's go to another comment here. This one comes from Ronnie. And I'm not going to go through this whole thing. So I'm just going to kind of like go through this. It's one thing. But obviously, here's this example. Two exercises, one after another, and they have kind of the same structure. So why don't we do this? We were thinking about the ease of movement here, although, the volume signature is the same. So that's kind of like this question. And I'm definitely recognizing this, guys. So I'm not like trying to go away. I think a lot of it also is kind of contextual, what comes then or what comes after. But let's just say that we went wrong on both of them. Let's just say that we said that this was a weak rally and this was an ease of movement. I think that your desire is to define everything and to define everything correctly. Whereas I'm kind of challenging you to be okay with mistakes in your analysis and have the process that corrects those mistakes. So how would we be correcting this mistake here if we're, let's say, wrong on both counts? What comes before that is not important because we basically give the definition of the bias, a wrongful definition, just on the rally. So a weak rally means that we're thinking distribution. And ease of movement means that we're thinking this is an accumulation. What is the process of correction? Well, what comes next? And this is something that I want you to think about a little bit more. I'm going to move a little bit forward here. So I've created this slide to show you both games, right? So, and this is the last bar that you see on both of them. I've created both horizontal lines and I've created downsloping lines for you. So now that I was explaining all of this, I want you to look at the rally and I want you to think what comes next. And I'm going to give you a little bit of a time to think about it. So let's just do this. This, and then this. So think about this for a second. How different are these, I'm sorry, not rallies, how different are these reactions? In which way? All right, guys, so let me see. What kind of comments we have. Okay, reaction for the second has less downward progress with the increased effort. That comes from Eric. Okay, so let me just write it down. For the second chart, so bias game 24, second has less downward progress, so result to the downside is less with the increased effort. Okay, so effort increase. Okay, bullish or bearish? Definitely bullish, right? So we have more effort that tries to push the price down. What happens? There is some kind of resistance, right? Whereas in the first case, in bias game number 25, look how price moves. Does it move easier to the downside? With the same increase in effort, I mean, I put these green lines on both of them, and you could see how the volume signature and the price structure resembles each other. So thank you for pointing this out. I mean, there are obviously a lot of differences. I was thinking about a different exercise here. I was thinking more like find, a dozen of differences and dozens of similarities in the price structure. Maybe we should do this. But this is probably the main difference between these two reactions. The character with which the price moves to the downside is so different. This spread goes down. Also, look at the thrust to the downside, right? Whereas we have an increase here, down thrust. What else? We see that this sell-in here is somewhat kind of like singled out to specific bars. There's really not a lot of bars that has some kind of consistency of selling. So you have to look at all of that. Plus, you have to look at where comparatively the price went. So in first case, when we look at the change of character, and that defines the law of the automatic reaction, we do the same here, and we want to see where this reaction goes to. And we see that the reaction in first case, in bias game 25, goes actually below the support level, whereas here it creates that higher low. So there are quite a lot of distinctions here. If you thinking like, okay, well, it looks similar. Yes, it looks similar because it goes through kind of the same structure. Uptrend, change of character, retest, then some kind of new lower low, and then this mysterious rally that we have, and then the reaction. So looks similar, and then the volume signature, there is a difference here. So let's come back to this. Looks similar as a structure, but then again, don't be kind of confused that there are some differences. Okay, well, what are the differences? How do we observe that difference? Well, first of all, the change of character has different character with which the price, travels to the downside and the volume signature. The first case suggests that there is just not a lot of selling. I mean, like there is some selling, but it's not intensive, it's not aggressive for the price to go down. So, and that's why we're still thinking here of reaccumulation. Here, the picture is different. The effort has increased so much, and yet the price is doing what? It's actually not covering a lot of ground to the downside, recovers really quickly. So result is actually quite positive. So result to the downside is diminishing. Effort increase, result diminishes to the downside, means that demand is behind it, and the bias is a reaccumulation. Then as we go further, we could see this area right here where a lot of supply that comes in and then being exhausted, through this process, it comes in and it starts to diminish, and there is an absorption trading rate right here. Whereas here we see increase, increase, increase throughout this reaction, and then a quick recovery. So this looks more like selling. This is where we are becoming a little bit more concerned. The rally looks the same. I agree with you. The only difference is the upthrust right here. If we would be just thinking about how we compare the structure, okay, well, we probably would be thinking this is the analog right here, last rally, and then we are failing here. We are failing here, but the way how we fail is so different. This is a very laborious move to the downside. This is much freer, has, more signature, more consistent supply signature behind it. There is a difference in the volume signature as well. So after this rotational reaccumulation right here in phase A, early B, we kind of seen the supply going low through the structure. Here we've seen supply going, increasing. And when we discuss accumulation and distribution, we usually attribute those volume decline characteristics to accumulation, supply decline characteristics to accumulation, and supply increase with the result increase to the distribution. What else? I also feel that, this was a little bit further down the path of where you could have seen this relationship between these two bars. Here, I couldn't really just say like, okay, go with this. Then it would be extremely obvious. If I'm, let's say, stopping the chart on this bar. And for you specifically, guys, I have no mercy for you. You're in this class. So I want to challenge you as much as I can. And it's through this challenge that we're going to figure out, how to deal with this. All right, let's come back. Okay, so Ronnie. Okay, so I think it's kind of probably difficult for us, to take, let's say, just the rally out of the context and to define whether it's a weekend's rally or is a movement rally. I'm probably always going to have that subjective bias here because myself and my team goes through the creation of these exercises, so we know the answer to this. But I think that the process is going to be, again, assess each rally, assess each reaction, and with each rally and with each reaction, create the story that goes back to the, to the end of the chart. Okay, I think we've covered this. Let's talk about, Arvin's questions here. Okay, so where did I go wrong in identifying bias from left to right? Exactly, a really good bridge for us here. Number one, switch to down bias on October 1st. Okay, so somewhere here. Yeah, and I think that even if we switch the bias just on the way down, we're kind of like seeing, this emergence of the supply and so on and so forth. I'm not necessarily like, oh, October 1st that the bias has changed. Probably after this reaction, yeah, I'm changing the bias. Switch back up bias on 11.1. Okay, I would probably be thinking again that yes, that's probably would be correct to think about. But again, if we're bearish here, then we need a conclusion of the rally. We can't really, I see what you're saying. Okay, so you're saying that if there is enough recovery here, this would be the first place. That makes sense, yes, so that's logical. Okay, so let's say that we are bullish here. Okay, so when is the next time when the bias switches? The rationale for continuation of the up bias at the higher low point in February or March. Okay, so we're looking here at the higher lows. Well, there is no need to go through the analysis, right? So again, where would we change the bias? I think right here, where we fail. You could also change the bias a little bit earlier on the test because you have the upthrust and then the test fails to overcome the upthrust. So you could make the switch even earlier. And then as the price goes down, supply is consistent. That's confirming the bias. And then you're waiting for the rally, and the rally again fails in the last portion of the chart in February. And that just confirms the bearish bias. So that rally definitely, this reaction and rally definitely, puts us on the offense as to, are we correct on the bias? And that probably is a confusion. And maybe that's the frustration that kind of like comes with like, well, the previous chart looks the same. What comes after that as the reactionary test to that looks different. Question number 2, highest volume. Yes, so why is this not CO buying? Well, you have to think about the places where CO would be a buyer, right? So we saw how there is some selling into the strength, and this is where CO is selling. Then there could be some other type of COs that would be buyers at this point, and they see in some kind of value. But as the price starts to fail, they might give up this position. And that could be it. They could give up this position further down the road into the right. All right, so they could buy here, sell some here, hold on even more, sell some here. This was not position that kind of like initiated really well. And when we talk about the high volume signature, we obviously talk about, the composite band, but also think about other institutions that participate, and they could be CO in one trade and they could be weak hands in another trade. So therefore, you constantly think about like a rotation, right? Are we rotating from strong hands to strong hands, and this is a reaccumulation, or we're rotating from strong hands to weak hands, and this is a distribution? So we need to think that some of the institutions will have a high signature behind them, but still will be on the wrong side of the trade. So therefore, we would be, just going through the swing analysis and trying to define the bias that way. Question number 3, effort is increasing compared to result decreasing, earlier analog, so bullish. Okay, so what are we looking at the result, right? So we've calculated 8.5 bucks, 8.5 bucks, the same distance. If this is the same distance, then we're gonna look at different things, right? So obviously a high, low, so that's kind of like a bullish case scenario. What is the character of the move? Well, the spread, as we went through this, and the volume signature confirms more of the bearish scenario where supply is increasing, and there is a synchronicity with the effort. Effort is increasing as well. So the only thing is the high or low, which suggests some kind of attempt to rally. We have the rally and then we have the failure here. So I think sometimes, we could be wrong in the buts right here, but the process should correct us and get us back on the right track. I mean, if we are going with the mistake somewhere in the middle of the range, the latest action should give us a clue as to what's happening here. Imagine this: you have only this data. Then what's your bias here? You're definitely going to define the bias as to the downside, and then you're going to have a short-term attempt to rally. And then out of the short-term to rally, these are the two most significant bars, and they're going to show you that whatever came here probably is of the same quality as here. All right. Here is your Wyckoff story. And I wonder, you know, obviously if I'm giving you this exercise, let's say somewhere here, somewhere here, somewhere here, you know, that's probably more of the distributional story. Why are we thinking here that this is still a distribution, by the way, guys? Anybody? Why are we thinking on this last point of supply that we're still in the distribution? Lower high, yes, absolutely. We have structurally we still in the lower high. We are still in the definition of the downtrend. Rally only goes 50% of the previous rally. Okay, yes, so another lower high here. Yes, and we have this trading range right here. So this looks like that low high failure. And we're committing below all of the support levels, right? So on this initial move, the rally is not that strong. It's not like this. It's not like this. It's not even like this. So a rally is a diminishing in quality. There is no demand that is coming in. Whatever demand has come here, there was no other demand after that. Supply does not have to be present if the stock has been sold already. It could just kind of tank under the weight of the price moving down, and we kind of see that. So this was a leadership stock before, and then you could see that the capitulation came right here. So they're still holding on through this area, hoping that it's going to go up, and then that's it. They have to close that position. Ease of down movement, lack of momentum in rallies, yeah, as well. Okay, so that was useful. We went through this exercise. Okay, yeah, a little bit more from Marvin here. So let's just kind of like go through this. Okay, so some things that I said discussing the bias game here. So let me just kind of address this. Okay, look at these two rallies. So I'm assuming this one and which one as well. There is a lot of momentum. There is a lot of aggression. Yes, there is a lot of momentum. There is a lot of aggression right here. In the distributional case, we also had a lot of momentum at the beginning, and this momentum started to fade at the end. Did you mean from the rally low to the rally high? No, that's not what I meant. There is a lot of momentum at the beginning of the rally, and then there is less momentum here. Question, and this is different from the step momentum, which is from the high of one rally to the high of the next rally within a swing, correct? Okay, so I'm not sure about the second question. And then the last two, we have only momentum of the initial kickoff bar. Okay, here, right, and then here. Yes, so would I have given you this would be a different picture, right? Because the momentum is so much different here. But intentionally, I did not do that. If you have a momentum and then failure, that's going to suggest either consolidation or a reaction. Same here, and everything is kind of happens in this way. But when momentum starts to improve in a significant way, then the test is going to be better. All right. We don't see significant momentum buying on the way up, and that's why it looks like a weak rally. Question, I actually see a lot of momentum bars, at least 5. Okay, so there's always going to be some kind of momentum associated with the reversal off the bottom, right? So all of these bars, they have some kind of increase of the momentum. The key is obviously to see how supply comes in and how it stops that momentum and the movement up. So here we're seeing, kind of like a free of substantial supply resistance highs that are being overcome by the price, and therefore momentum still continues. But as the rally unfolds, that momentum starts to go down. If there is something missing in this picture, it's the momentum signature that we usually have in phase D. Question, now you're talking about volume, right? Right here, yes. All right. Well, again, each rally is going to have a momentum, right, behind it. It's just a matter of what kind of momentum do we have? Do we have an increase in momentum? So, for instance, if we would be taking this area right here and would look at all of the up bars, and then we would say on this rally, momentum definitely has increased. So that's what I mean by the increase of the momentum on this rally. Relative to other rallies compared, let's say, to this one, this is could be, a momentum of a different quality. Momentum here is going to be different than this one. The price moves much faster here, so both momentum and velocity will increase. This required this type of, momentum just because where they bought was in phases A and B, and then going into C and D, there is really more like a technical rally that where the price goes up just based on the diminished supply, the supply that has been observed in this area. So there's no really a lot of need for the demand. So therefore that momentum is there. It's increasing initially, but compared to other rallies, it's not the same. And that's just a reflection of buyers having bought already and they're holding on to this position, and sellers are not necessarily coming in and selling aggressively. No momentum players, so value buyers do not have momentum signature, only momentum players. Yeah, I'm thinking about this definition, what's the correct way to say this? I definitely see the logic here of saying, okay, well, off the momentum, you could develop, off the value buy here, you could develop that momentum. That's definitely a case. But also, you might have a lot of the, value buying that doesn't really create a lot of momentum signature. It's kind of like still going to be, in a trading range. So would we say that the value bar is a causality for the follow-up momentum? Yes, of course, but it doesn't necessarily mean that this momentum is going to increase significantly to give us the signal or to be, sustainable for quite some time. We see that, in this trading range. All right. Okay, well, hopefully we've addressed all of the questions. Here's the next bias game. Now, I also had a thought and discussion with one of you today about the fact that I actually ask you guys to give me your bias in the class. And I thought about this, and the argument was, well, it takes time to come to the conclusion what the bias is. And if I give you the bias in the class it might be erroneous bias, just, you know, something that I quickly look at. I didn't have chance to analyze, you know, and then I kind of psychologically, mentally already tied up to that bias, right? So I'm really, really, really thinking subjected to the bias that I voiced in the class. And I think that when I started doing this, that's when frustration actually started as well. So you tell me, guys, do you want me to ask what is the bias here right now? Or do you want to just keep it to yourself? Why don't we do this? Why don't we experiment with this? I'm not going to ask you for the bias here. But you can think, like in your head, you can think about this. Yeah, it's like, okay, well, what's the bias here? Okay, so that's the next exercise. Let's see where we're gonna end up with this. All right, so let me see if I have something that I wanted. Let's go through the market charts. Okay, so we have plenty of time. So we'll come back to the bias game because this is going to be the subject, you know, of our whole class today. Sean has sent a couple of positions, you know, something that we've discussed already, AMD, so I'm not going to discuss that, but this is another position, so let's quickly look at this. And the question here, any advice on how to manage it? Okay, so this is Disney. Obviously, Disney has this fever of streaming wars. So it's something where they are positioned quite interestingly with a lot of content and a lot of platforms that they have for the content delivery. They also have, you know, cable penetration, you know, with many channels there. So this is something that is very attractive right now as a theme and as a stock in particular. So if you're entering, let's say on this day, I'm assuming your stop loss is going to be somewhere here, and I'm assuming that we're thinking that this is phase C. How do we handle this trade? Well, we think about the points of entry on the schematic, right? And we're thinking where the possible add-ons if the price confirms. Actually, let me just bring up a fresh chart on this, the latest. I just feel that okay. Let's go to stock charts, and what are we discussing? We're discussing Disney. Simon is asking, what was Sean's entry criteria? Price above resistance over a certain rate of change level. And I don't think that Sean is with us live, so you know, Sean, as you are watching this recording, you know, if you have a chance to answer this, just email. Yeah, you could do this. Okay, so no, let's go to Disney. Let's go through the chart really quickly, just to understand the history. We are price cycle wise in the huge reaccumulation that had a huge sign of strength in the backing up action as a trading range. So we're thinking phase C here, right? So how do we manage it? We basically want to add a significant chunk right here. Why? Because out of the backing up action, what's going to happen next? An uptrend. And how would we manage our stop loss, which is right here, below this low? Well, every time we have some kind of commitment to the upside, we're going to move the stop loss. Whenever we have an oversold condition, we would be thinking about adding on. Whenever we are in the overbought condition, we would be thinking about taking profits and hedging. And then obviously the movement of the stop loss would be in such way that would allow the main position to stay on, especially after this type of kickoffs. And by the way, this is going to be the topic as to how do we trade long-term campaigns and how do we swing trade long-term campaigns for December special. So we will have a registration page ready for you by the end of this week. So we want to catch those moments and move the stop loss accordingly. If you're a long-term investor, it's when there is a big commitment out of the oversold condition. This is when you move the stop loss. If you're a swing trader, then you will be moving the stop loss into the overbought condition and trying to get out on the first change of character. That's what you would do. So very exciting stock, and obviously let's see how this trade is going to unfold. Okay, what else is here? I think that's it. Somebody was asking about the momentum. Yeah, and we're going through the momentum in the November special on Thursdays. Thursday is going to be the last class. Very interesting, challenging topic, and we're having a lot of discussions there. I definitely want to understand more about, how momentum is being formed, and we are the classroom environment is just so great just to do exactly that. So for those of you guys who still would like, to attend, obviously just buy on demand and catch up until before the last class. I like this declining momentum, and then we have a breakout in that. And before that, we have a divergence, right? So we have low on the price, high low on the momentum. So we're seeing this also in the signature itself. For instance, when we look at this decline, there is a lot of momentum to the downside, and the momentum is making the new low. When we look at the next decline, we see that it takes more time to decline. So momentum must be have slower rate of acceleration. And also we're looking at specific bars, and there are only like 3 bars that are really like for sale there. Also look at the signature again. We kind of seen this in the bias game. Increase of the supply. Let me take it out of the color. Increase in the supply signature. And then how do we see this move to the downside? Increase and then decrease. So different construction of the reaction. Look at this one right here. 1, 2, 3. So it has that decrease in supply signature. So here we would be thinking that, wow, the bias could have changed. And let's say we are in the bearish bias. Then we're thinking the rally. Okay, rally was weak, still bearish. There is no really demand that comes in. There is no momentum that overcomes the previous highs. So everything looks weak. We're still in the bearish bias here, at least short term. Then when we go down, we see that momentum deterioration, and we're saying conditions are changing. And we want to look at the next rally or how it starts to develop to see if this bearish bias will be confirmed or fail. All right, well, how do we do that? Well, we basically analyze this whole area right here, and we're starting to see that the volume signature starts to increase a little bit, and that is on the background of higher highs, higher lows. Why would the price do that? It's only after the absorption of the supply. So did we have that? Okay, let's go through this again. Supply increase, some supply. This looks more even as a demand bar. So less a supply. Down momentum goes, the rate of acceleration to the downside goes down. And then we don't have any more selling. Selling is exhausted. And then the last test on selling, and we go nowhere, we're creating a higher low. So there is a change of behavior. And then once we start seeing this is where we're saying, okay, the volume is definitely coming and pushing the price up. So there is some demand behind it. We're breaking the short-term trend line as well, also acts as a confirmation. So volume acts as a confirmation, price acts as a confirmation, trend lines act as the confirmation, momentum acts as a confirmation that something different is going on. And then you're thinking, okay, well, now that we're switching the bias to bullish, would the rally behave in a bullish way? Would it overcome the previous level of commitment? Yes. If this is the case, probably sign of strength. Backing up action should follow. We should have some kind of weakness. If reaction develops in a more bearish way, then we would change the bias to bearish at this point. All right, well, good trade, good entry. Is price also creating an apex? We could probably extract some apex, right? So something like this into this spot right here. If you've seen it like that, yes, probably. Okay. Anatomy of the trade. I took Corey's work here. So really quickly, it's kind of similar to everything what you guys are sending me on the homework for the trader anatomy of the trade. Again, something that we've discussed before, and now we're just seeing how it materialized, right? So a lot of us had this feeling that, this is it, it's done. But again, think about the character with which the price moves, or the structure. We're seeing the stop in action, buying climax, then we're going through this reaccumulation phase, suggest the move up. It moves up, spends a lot of time here. Sometimes this is the strength in phase B. And then it goes and creates a higher low. How does it go down? First move to the downside, second, third, fourth, fifth. Okay, first, second, third, fourth, and then fifth. Okay, so we see how supply is diminishing as we're going through this process of going down to the higher low, stopping, and then starting to create higher highs and higher highs locally. And then on the last bar right here, and actually I was watching, the stock, on that day, and I was like, this is it, because it brought some demand behind it, and then the next bar has also a huge volume signature absorbing that remaining supply, and off we go, and then obviously confirmation bar. So when you look at the long-term price cycle, and this is what I was alluding to, guys, it's actually in this long-term oversold condition, and that's why it looks so bearish by the characters, because to get into this oversold, there should be some kind of selling that, should happen in synchronicity way where, effort is increasing and that pushes the price down. But once it gets to this point, a lot of the institutions are going to see this as a value zone. And the confirmation of their buying is going to be in this momentum signature and in this type of volume. It's that volume kickoff, momentum kickoff, structure kickoff of the low in phase C. Something, by the way, that we could, create the scan for or filter or code it. This seems to be kind of like a very easy scannable moment. All right. Well, thank you, Corey, for that.